Good morning or good afternoon, depending on when you're listening to this website. My name is Jonathan Chapman. I'm a tax partner with Feely & Driscoll, and I've been with Feely & Driscoll for a number of years now. Feely & Driscoll is a firm in Boston providing tax, audit, and consulting services for over 40 years. And I'm glad to be here this morning to talk a little bit about our topic, and that is the seller and buyer opportunities and pitfalls involving the business sale. Now, we will have a series of slides and exhibits that we'll be going through, but something that's probably going to be a little bit easier, although a little bit lengthier, in reviewing a lot of this material that goes into more depth is an article that I wrote last April for the Construction, Accounting, and Taxation Journal entitled The Business Sale, An Adventurous Journey. And I get into a lot of these topics, again, in considerably more detail than we'll be looking at today. If you would like a copy of that article, please email me at jonathanc@fdcpa.com, and I'll be happy to send you a PDF copy of my article. So, again, today we'll be looking at some of the pitfalls and planning opportunities involved in buying and selling a business, and we're going to be focused in a corporate setting. And we'll begin with a fundamental review within a tax context between the differences between C corporations and S corporations. We'll then be looking at the buyer and seller considerations, again, both in the context of a C corporation and then alternatively an S corporation. There's an election that's available. It's a valuable election where we're selling stock in a corporation and the stock is sold to individuals. We'll get into some of the particulars on this. This can be a very helpful election. This is an election under Section 336E of the Internal Revenue Code. We'll take a look at some of the pitfalls and some counterintuitive horror results involving an asset sale followed by a liquidation, and where gain can be accelerated and some horrific results could come of that. And we'll get into some of the particulars on that in a minute. And there's another pitfall involving the accelerated tax on the installment sale and how we avoid that. And then finally, we will talk a little bit about some of the due diligence considerations in connection with a stock acquisition. Okay, so turning first to the fundamental differences between the C corporations and S corporations. The C corporations, as I had mentioned, the taxable income is taxed twice, once at the corporate level and a second time upon distribution, either as a dividend or a liquidation at the shareholder level. The corporate level rates with taxable income in excess of $75,000 up to $10 million is at 34%. We have lower rates going up to $75,000, and these lower rates are 15% and 25%. And these lower rates are phased out, and from $1, income is taxed at 34% once taxable income reaches $335,000. The shareholder level, once a distribution is made, the shareholder level, we have a 20% capital gain rate, and as a C corporation, we have a 3.8% net investment income tax. We have a combined rate of 49.7%, and we'll go through this example here that'll illustrate this. Here we have a corporation with taxable income of $500,000. So the lower rates are completely phased out now, and from $1, we're going to be taxing that at 34%. So that comes to a corporate tax rate of $170,000. Now at the shareholder level, we have after-tax corporate income of $330,000 at the corporation. And once that's distributed, either in liquidation or stock redemption or as a capital gain, we have a rate of 20%. And on the $330,000, you can see this will result in a tax of $66,000. And as a C corporation, the shareholder is also subject to the net investment income tax of 3.8%. So that adds on another $12,500. So when you add all these together, we have a total corporate and shareholder tax of $170,000 plus $66,000 plus $12,500, coming to a total tax of $248,500 or 49.7%. Turning to the S corporation in the next slide, the taxable income is generally taxed only once at the shareholder level. And this tax can go up to 39.6%. Again, the 3.8% if the shareholder, and we'll get into this in a minute, but if the shareholder is passive involved in connection with the S corporation in terms of the shareholders' activity, there's an additional 3.8%. So upon liquidation, again at the C corporation level, we come back to that same 49.7% tax. That includes the 20% capital gains tax as well as the 3.8% net investment income tax. The S corporation, again, the corporate tax is generally zero, and the shareholder will have a 20% or 23.8% in connection with a liquidation based on the difference between the shareholder's stock basis and the distribution proceeds in liquidation. So the two entities are fundamentally different in connection with how they're taxed. So we go to the next slide and we get into some of the buyer considerations and seller considerations. And on slide 6, with respect to a C corporation where we have a stock sale, the difference in rates come into play where in the stock sale, assuming the stock has been held for more than 12 months, we come back to the same 23.8% tax. As an asset sale followed by a liquidation, we come to a combined rate of 49.7%, again using the same math at 34% at the corporate level and then 23.8% tax at the shareholder level based on the net proceeds to the shareholder. Turning to slide 7, we talked a little bit about this passive tax, this net investment income tax of 3.8%. Going through an illustration of this, in Exhibit 1, we have a tax basis balance sheet. We have certain assets at fair market value, and this happens to be a cash basis corporation. And so we have receivables with a fair market value of $500,000 and a tax basis of zero. So we have a potential gain of $500,000. Equipment, we have a fair market value of $700,000 and a tax basis of $150,000. So our potential gain is $550,000. That too will be ordinary as well as the receivables. And then we have other furniture and fixtures, the same theory. We have ordinary gain of $125,000. And then we have goodwill of $1 million, and that's going to be taxed as a long-term capital gain. So when we go through this, we have a sales proceeds of $2,350,000. That's the full fair market value of $2,450,000 less the liability of $100,000. And so we have $2,350,000, and we have a basis of $175,000. So that's going to result in a long-term capital gain of $2,175,000. Tax at 20% is $435,000, and net proceeds, therefore, comes to $1,915,000. Then we have the net investment income tax to look at. That's 3.8%. And again, to the extent that the shareholder stock basis is less than the inside basis, we have a potential net investment income tax of 3.8%. And an example goes through this, and by the way, my article goes through this in a lot clearer than we can in the slides. But basically what we do is we look at a hypothetical sale of the assets in the S corporation. And we realize a gain on this hypothetical sale of assets. In the context of an S corporation, that gain would increase the shareholder's basis, so that where we have a gain of $2,175,000 and we have a basis of $175,000, then we have a after gain basis of $2,350,000. Now the gain on the liquidation, and then it's this hypothetical gain on liquidation which would determine our net investment income subject to 3.8%. The proceeds would be $2,350,000, and the stock basis is also $2,350,000. So our investment gain is zero, notwithstanding that the shareholder may be passively involved in the business. There would be no investment gain. So we go to slide number 9, and we contrast that where the shareholder doesn't have the same $175,000 inside basis in his or her stock. but instead that shareholder purchased that stock from the outside and for $75,000. Now we have the same hypothetical gain on the asset sale of $2,175,000. The after-gain stock basis is now $2,250,000, which again is a $2,175,000 gain on the hypothetical asset sale that we just went through, plus a $75,000, which gives us a $2,250,000 basis. So now the gain on this hypothetical liquidation will have the same proceeds of $2,350,000. We now have a stock basis of only $2,250,000, so we have a gain of $100,000. So the inside equity basis of $175,000 versus the outside basis of $75,000 results in $100,000 being deemed to be net investment income, and that piece would then be taxed at 3.8%. So I realize that just kind of talking through this and looking at the slides and so forth, this sounds to some of you who have not been through this or not familiar with it is a bit confusing. So if I would suggest you go through the slides a bit deeper and go through the examples, but I would also suggest that if you'd like, you could email me and I will forward a copy of my article that goes through this in a little bit more detail and a lot clearer than we can express it in slides. All right, so now if we go to Exhibit 3, we'll look at what happens with an asset sale, because that is generally an issue between the buyer and seller as to whether the buyer is going to buy assets or buy stock. And many times it makes a significant difference between the buyer and seller as to whether a stock sale or an asset sale structure is used to buy and sell the business. So in the asset sale, again going to Exhibit 3, the asset sale, we have the same sale proceeds of $2,450,000, but the gain that is going to be generated is going to be taxed much differently at different rates than a straight stock sale. And the reason for that is that, going back to our balance sheet, with a cash basis corporation, we have certain assets that have value that will be purchased, but instead of being taxed at capital gains rates, as we would with a stock sale, we'll have ordinary income rates. So going through this, Exhibit 3, we have a sale proceeds, again, of $2,450,000. We have accounts receivable of $500,000. Now, as a cash basis taxpayer, the basis in those assets would be zero, and they would be taxed at ordinary income rates of 39.6%. So you would have a tax of $198,000. The equipment, we have depreciation recapture of $550,000. And that's going to be taxed at 39.6%, so that'll be a gain or a tax of $217,800. We have furniture and fixtures. Same rule applies with respect to depreciation recaptured at ordinary income rates, $125,000 at the same rate at 39.6%. And then finally we come to goodwill, which is the $1 million, to round out the full $2,450,000 of sale price. And that's taxed at 20%, so we would have $200,000 for a total tax of $665,300. The after-tax proceeds, therefore, of the $2,450,000 will come to $1,784,700. We pay off the note payable on the equipment of $100,000, so the net proceeds comes down to $1,684,700. Exhibit 4 then contrasts the two. The stock sale, you'll recall, has a net proceeds of $1,915,000. The note proceeds on the asset sale is $164,700. So there's a significant difference in terms of how we structure this transaction, whether it's an asset sale or a stock sale, because the excess proceeds from the stock sale is $230,300. Pretty significant amount. In our next slide, we're going to talk about a very special election under Internal Revenue Code Section 336E. As I mentioned at the outset, this is in form a stock acquisition, but for tax purposes, it's going to be treated as an asset acquisition. There's another provision under 330-H10 that provides the same result as a 336E, but the restriction with the H10 is that it's limited to corporate buyers. But the 336E does not require a corporate buyer. So in many cases where we're selling a corporation to an individual or an entity other than a corporation, 330H10 would not apply, but 336E is an election that could apply if the buyer and seller agree with that to treat it as an asset sale. Let's go through some of the requirements of 336E. First of all, the selling S shareholders, and we'll speak in the context of an S corporation. Selling S corporation shareholders sell at least 80% of vote and value of their stock within a 12-month period beginning on the date of the first sale. And all S shareholders and the S corporation enter into a binding agreement to make the selection. So the selection is subject to a binding agreement between the two parties. The target S corporation, once we meet the 80% test, vote and value within 12 months of the sale within 12 months, once that 80% test is met, the target S corporation is deemed to sell all of its assets on the disposition date. That disposition date is the date on which that 80% test is met. Importantly, the S election continues through the close of the disposition date, and this is on the next slide. And the reason why that's important is that as of the end of the disposition date, or on the disposition date more specifically, that's when the deemed sale has occurred. And so we want to make sure that that day, when the 80% test is met and the deemed sale occurs, we want to make sure that we're an S corporation and not a C corporation. So specifically, the rules provide that the S election does continue through the disposition date. This is contrasted with other S rules where the S corporation terminates on the day the corporation ceases to qualify as a small business corporation, which means if you've done something to disqualify the corporation to be an S corporation, on that day you are no longer an S corporation, you're a C corporation. So this is an important, albeit subtle, but this is an important distinction between the two. The following slides illustrate a rather nasty trap and ways to avoid this trap. Specifically, we're speaking here with respect to installment obligations, where an S corporation sells its assets and receives an installment obligation. So on page 17, we go through the various steps involved here. The S corporation sells its asset and receives an installment obligation. The second step, the gain on the installment obligation is the tax is deferred as the payments are made under the installment obligation. So we have a matching here. We have a matching of the proceeds received on the installment obligation and the tax obligation with respect to the gain attributed to those installment payments. Step 3, the S corporation distributes the installment obligation to the shareholders in liquidation. This is where the surprise starts. In step 4, the shareholders intuitively conclude that the gain continues to be deferred under the installment obligation as the payments are made. However, in step 5, the shareholders are surprised because the deferred gain on the remainder of those installment obligations is triggered upon the distribution of the installment obligation. Now, this can be a real problem in the sense that we have the tax due and we don't have the cash to pay the tax because the installment obligation continues beyond that. So what we've done is we've terminated that matching of the tax obligation with the receipt of the insurance or the installment sale proceeds. In the next slide, 18, we have an avoidance of this triggered gain on the installment obligation through a couple of steps. And first of all, the S corporation is adopting a plan of liquidation before the asset sale. And then the S corporation makes a distribution of liquidation within the 12-month period beginning on the date the plan of liquidation is adopted. Now, I actually have this situation with a client where the sale has already taken place. We have an installment obligation with respect to goodwill with a zero basis and several millions of dollars of the fair market value, the proceeds from the sale. to be distributed as they're to be paid as the installment obligation is paid. And here we are intentionally keeping the installment obligation within the corporation and not making a liquidating distribution, but instead keeping the corporation alive as the S corporation is receiving the distributions, or the payments, I should say, from the installment obligation. And so we have a continued matching. We turn next to a very important topic, which isn't necessarily tax related, but it's tax and non-tax, and that is the due diligence process in a stock acquisition. Again, unlike buying assets, where you generally, although there could be issues going forward upon the acquisition of assets, in acquiring stock, there could be all kinds of different issues that are lying there that waiting to be triggered that requires a certain level of due diligence in looking at exactly what those exposures might be. For example, the tax costs to the buyer for built-in gains in a stock purchase transaction, the buyer could be exposed to that, where it's something peculiar to S corporations, where we have a gain on the sale of certain assets that will trigger a corporate level tax. Not to get into particulars on that, but this is something peculiar to an S corporation that, again, I get into a little bit further in my article. But that's something that would hopefully be picked up in due diligence so that we don't have exposure to that. There's also exposure to corporate liabilities, and these will be both known and unknown liabilities. The seller many times may be agreeable to entering into an indemnification agreement with regard to known contingent liabilities, but obviously will be reluctant to indemnify for any unknown liabilities as potential tax issues. For example, something that would be catastrophic in connection with acquiring S corporation is the possibility that the S election may have unknowingly been terminated in a prior year. Upon an IRS examination, this could result in a considerable amount of taxes at the corporate level. As also a consideration here are certain contracts that may not be readily transferable in a stock acquisition, such as corporate agreements with third parties. Examples may include favorable lease agreements between the building owner and a corporation, and employment agreements with key employees. Although the agreements between the third party and the corporation as an entity continue to exist under stock acquisition, the agreements may be subject to a renegotiation between the third party and the corporation where there has been a change in the corporate control. This could prove very costly and destructive should this be discovered after the stock is acquired. Franchises may be terminated after a change in control to the buyer. Key employees critical to successful continuance of the business may have renegotiation rights upon a change in the control of the buyer. So all of these things and more are very important to consider in structuring the stock acquisition, making certain that the buyer is protected and the seller knows what is being identified. So at that point, I think we've gone through all the material. And again, I would suggest that you email me your email addresses if you're interested, and I'd be more than happy to send you a copy of my article that goes through these topics in a little bit more detail and some additional issues as well that I get into in my article that we simply don't have time for in our slides. So with that, I thank you for your attention and look forward to hearing from you. Thank you.